Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 9th of August. I'm Daniel Lam, your host for the podcast. We've been spending much time talking about the developments in equities over the last couple of weeks. In terms of fixed income, we have discussed the US Treasury yield, but somewhat lacking for the other sub-asset classes. So let's try to fill some of this void today by talking about developed markets high-yield corporate bonds. Now the yield premium there over treasuries, i.e. the spread, have recently tightened. What are the drivers there? So first of all, from the macro perspective, US growth has been resilient. Compared to investment-grade corporate bonds, the high-yield corporate bond spread tends to move in lockstep with economic growth. So in that sense, this is a common driver for US equities and high-yield corporate bonds. The positive economic surprise has been helping both asset classes. Now, digging deeper into the micro side of things, 80% of reported companies in the US have beaten expectations in the current earnings season, with earnings surprise at a solid 7%. So this helps soothe concerns about the company's ability to earn cash, to meet coupon and redemption obligations. Looking at credit worthiness, credit metrics have been deteriorating, but from a high starting point. For example, the net debt to EBITDA ratio for DM high-yield issuers rose in the last 2 quarters, but remains well below its COVID peak. Moreover, many companies front-loaded borrowing prior to the start of the central bank rate hiking cycle, cushioning the impact of rate hikes. So now, how do we see DM high-yield corporate bonds going forward? Well, we would suggest trimming into the recent rally and rotating into other areas in the bond space, such as Asian dollar bonds. This echoes our idea to rotate some exposure in US equities into Asia ex-Japan equities. Data suggests that US recession risk is likely delayed but not averted. So this in turn poses a potential downside to corporate earnings, deterioration in risk sentiment, and therefore widening of DM high-yield corporate bond spreads. Moreover, this comes against a relatively expensive valuation starting point. So that is all from me for today. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.